In the early morning glow of the crypto revolution, everything seems calm. Bitcoin is soaring, Ethereum is blooming, and a digital future feels inevitable. At the heart of this new world sits a hidden weapon, Tether. Few outside of crypto have even heard its name, yet Tether's USDT stablecoin has become the lifeblood of crypto trading. It promises $1 for every token, a safe haven through crypto storms. For years, that promise kept the frenzy going. Traders could cash out into USDT when markets dipped, then surge back in when opportunity returned. On the surface, all is well, but beneath the surface of this apparent stability, questions begin to swirl. Is USDT really as solid as it claims? What if the pillar propping up the crypto markets is built on a lie? In this calm before the storm, few notice the dark clouds gathering, hints of an illusion that could shatter the foundation of crypto's meteoric rise. This is the story of Tether, a story of dominance, deception, and a delicate balance holding up $1 trillion dream. The stage is set, the players are in motion. A storm is coming. Our journey begins in 2014, when a small group of tech entrepreneurs unveiled a bold idea, originally called Realcoin, soon renamed Tether. The vision was simple yet powerful, a digital token pegged to the US dollar, combining crypto speed with the dollar's stability. In an infant crypto market plagued by volatility, such a token was a godsend. Exchanges and traders quickly embraced USDT as the dollar substitute. By 2017, as Bitcoin mania swept the globe, Tether had quietly become the dominant stablecoin, the grease in the wheels of every major crypto trade. Yet, from the very start, Tether's origins lacked clarity. Its founders and backers, an overlapping circle of crypto exchange operators and businessmen, operated from the shadows. The same leadership that ran the Bitfinex exchange also controlled Tether, blurring lines and raising the risk of conflicts of interest. By late 2017, over $2 billion of USDT were in circulation, but no one had ever seen an audit confirming the dollars supposedly backing each token. Through whispers and the occasional blog, a few voices questioned Tether's truthfulness. Was each USDT truly backed by a dollar in a bank? Or was a new digital Federal Reserve in the making? Early warning signs flickered, but were largely ignored. In January 2018, news broke that US regulators had subpoenaed Tether and Bitfinex, demanding answers about their finances. The crypto world held its breath, but Tether's keepers offered reassurances, and the market, hungry for liquidity, looked the other way. No proof of funds was made public, yet trading continued, business as usual. Tether's supply kept growing, and traders shrugged off the concerns, addicted to the stability and liquidity USDT provided. As one bull market gave way to the next, Tether became the interlocking nuts and bolts, keeping it all afloat, a pillar so critical that few dared imagine what would happen if it cracked. Tether's rise was relentless. By the early 2020s, USDT was involved in over half of all Bitcoin trades globally. It linked crypto markets in the US, Europe, China, and beyond, a borderless dollar. All the while, Tether's inner workings remained a black box. The company promised annual audits, then quietly postponed them. Banks in one country would cut off Tether's accounts, only for new banking relationships to mysteriously appear elsewhere. It was as if Tether existed in a parallel financial universe, always one step ahead of scrutiny, but that couldn't last forever. The truth was beginning to strain against the seams of Tether's story, ready to burst into the open. The stage that had been set during these boom years was about to reveal an unsettling twist, that the very foundation of Tether's stability might be nothing more than a carefully crafted illusion. The illusion began to crack in 2019 in a New York courthouse. Under pressure from the New York Attorney General's office, Tether's parent company reluctantly opened its books, just a peek. What emerged was shocking. Tether was not fully backed by cash. In fact, on April the 30th, 2019, Tether's own lawyer admitted only 74% of USDT tokens had real fiat or equivalent backing that moment. The rest? It had been loaned out to affiliated companies, used to cover up a financial hole at Bitfinex, a hole of roughly $850 million that had vanished into the shadowy world of offshore payment processors. The stablecoin, designed to be as safe as dollars in a bank, was in reality running a fractional reserve. This was the first definitive crack in Tether's facade, but it wasn't the only one. Investigators and regulators kept digging. In 2021, the Commodity Futures Trading Commission uncovered that for much of Tether's early life, it did not have 100% reserves on hand at all. In fact, between 2016 and 2018, there were only about 6 months in total when Tether was fully backed by equivalent assets. Only 6 months out of years. The rest of the time, the stablecoin was, at least in part, a phantom, tokens backed by nothing. Tether had mingled funds and lied that it would conduct professional audits. The CFTC fined the company $41 million for these untrue or misleading claims. Most still looked the other way. Cornered by regulators, Tether, likely against their will, disclosed a breakdown of its reserves in mid-2021 for the first time. The revelation stunned observers. Of over $42 billion in claimed assets, only 3.87% was actual cash. The majority was invested in commercial paper, essentially short-term IOUs, whose issuers Tether refused to fully identify. The rest was a mix of loans, bonds, even crypto investments. In other words, for every Tether in circulation, there often wasn't a physical dollar sitting securely in a bank vault. Instead, there were risky loans and questionable instruments that could default or drop in value. The world's biggest stablecoin was backed by assets that were anything but stable. This was no accident, this was by design. Tether had repeatedly promised independent audits but delivered none. The only glimpses of its books came under legal scrutiny. Each glimpse painted a troubling picture, a multi-billion-dollar entity behaving like a shadow bank, moving money in darkness, running on trust rather than transparency. For years, Tether's billions of users and the wider crypto market took it on faith that $1 in USDT was as good as $1 in hand. That faith propped up the market. But was it misplaced? As investigators peeled back the layers, the illusion of a fully reserved stablecoin was unmasked. The alarms were ringing. The world now had proof that Tether's stability was, at times, a complete mirage. Yet, incredibly, the crypto markets kept spinning. How could that be? Part of the answer lies in what Tether was being used for. To understand why so many were willing to look past these red flags, we must follow the money flowing from Tether into the crypto markets, and how those orders may have been deliberately orchestrated to keep the party going. As Bitcoin's price skyrocketed in 2017 from under $1,000 to nearly $20,000, the world gasped in disbelief as a new financial reckoning dawned. But behind that historic rally, researchers later found an invisible hand at work, an unseen mechanism largely powered by Tether. In 2019, a groundbreaking academic study titled "Is Bitcoin Really Untethered?" rocked the industry. The researchers, John Griffin and Amin Shams, sifted through mountains of trading data and made a startling claim. Just 1% of hours with heavy Tether flows accounted for 50% of Bitcoin's entire price surge that year. It appeared that massive amounts of USDT were issued and sent to exchanges at carefully timed moments, often following Bitcoin dips, and used to buy up Bitcoin, pushing the price back up. The impact was drastic. The study concluded that this pattern was attributable to one large player on the Bitfinex exchange, stealthily propelling Bitcoin's value with an almost puppet master precision. If true, this meant that Bitcoin's 2017 bull run, one of the greatest asset rallies in history, was not purely organic, but rather juiced by targeted Tether injections. The idea that a single stablecoin controlled by a handful of people could sway the entire crypto market was staggering, yet the evidence kept mounting. Observers noticed a recurring pattern. Whenever Bitcoin or other cryptos slumped, new Tether tokens would mysteriously appear, flowing onto exchanges to buy the dip. It was as if a buyer with endless dollars kept stepping in to catch a falling knife, a buyer whose dollars were in reality freshly minted USDT. Whistleblowers and critics like the anonymous analyst Bitfinex sounded the alarm in real time, documenting how Tether issuance correlated uncannily with market pumps. By late 2019, these suspicions were solidified into a massive class action lawsuit. Plaintiffs alleged that Tether and Bitfinex executed a sophisticated scheme to fraudulently inflate the price of Bitcoin and other cryptocurrencies, printing billions of unbacked USDT out of thin air to drive prices upward. The suit argued that this manipulation led to the 2017 bubble and its eventual crash, causing over $1.4 trillion in damages once the bubble burst. Tether, of course, denied all these claims, insisting that every token was backed and that any correlation was coincidence or demands driven. But consider the incentives. If you control a money printer that traders treat as real dollars, you can create buying power at will. You can ignite rallies, squeeze short sellers, and generate a market euphoria that feeds on itself. All while outsiders believe the rally is natural and pile in with real money, which can then cover the tokens you printed. It's a feedback loop of fabrication and FOMO, and if this loop was indeed at play, it means the market was dancing to Tether's tune, perhaps without even realizing it. If Tether was the invisible hand propping up crypto prices, it raises a chilling question. What happens if that hand is withdrawn or forced away? The market that soared on artificial wings could just as easily plummet. By 2020 and 2021, even as Tether's reserves issues came to light, the crypto market's dependence on USDT only grew. It was a classic case of too big to question. Pulling on this thread threatened the entire house of cards, but by now, regulators were wide awake, and they were beginning to piece together just how far-reaching the Tether machine had become. The next act in this complex storyline, a showdown between Tether and the law, a confrontation many say was long overdue. You can bend the rules for a while, you can operate in the shadows, move fast and break things, until the law catches up. By the early 2020s, Tether had painted a giant target on its back. Regulators and prosecutors around the world smelled blood in the water. In New York, the Attorney General's multi-year investigation concluded in 2021 with a damning settlement. Tether and Bitfinex admitted no wrongdoing, but paid $18.5 million and were barred from operating in New York ever again, after the authorities concluded they'd deceived clients and covered up massive losses. The settlement order revealed how Bitfinex borrowed hundreds of millions from Tether's reserves to paper over its missing funds, confirming the very worst fears about commingling and reserve fraud. New York's top law enforcer flatly stated that Tether's claims about backing were a lie, and that the company had been essentially engaging in illegal activities in the financial capital of the world. And New York was just the beginning. Federal US investigators ramped up their efforts. The Department of Justice launched probes into Tether on multiple fronts, from bank fraud to money laundering. According to reports in 2022 and 2023, DOJ officials were digging into whether Tether executives lied to banks in its early days, masking the nature of its business to maintain access to the financial system. Essentially, did Tether trick banks into holding the hundreds of millions that backed USDT by pretending those funds were something other than crypto related? Such deception, if proven, amounts to bank fraud, a serious federal crime. By late 2023, this investigation was transferred to the US Attorney's Office in Manhattan, a sign that the most seasoned prosecutors were now on the case. Subpoenas were flying, grand juries settled behind closed doors, the noose was tightening. Then came the next bombshell, suspicions that Tether may have facilitated sanctions evasions. In October 2024, the Wall Street Journal reported that the DOJ was also examining Tether for possible violations of US sanctions and anti-money laundering rules. The stablecoin that had become the coin of choice in places like Russia and Iran was now under the microscope for potentially enabling illicit finance on a global scale. Tether's leadership responded. The newly appointed CEO, Paolo Ardoino, insisted they'd seen no indication of an active investigation. But the market's reaction told a very different story. Even a whiff of DOJ action caused a slight depeg in USDT's price, a tiny tremor of the earthquake that could come. And it's not just the US anymore. Around the world, regulators are waking up to the systemic risk that an unregulated, opaque stablecoin could pose. In Europe, new laws under the MiCA framework will demand that stablecoin issuers like Tether have transparent reserves and meet strict standards, or be shown the door. Many of the largest exchanges have already started delisting USDT. In Asia, authorities in Singapore, Japan, and others have tightened oversight of crypto assets, knowing that Tether's reach extends into their jurisdictions too. Even offshore havens that once welcomed anything goes crypto businesses are growing wary of being the weak link that facilitates a multi-billion-dollar implosion. Tether now faces an abundance of legal peril, civil suits accusing market manipulation, regulatory fines for past misdeeds, and the looming spectrum of criminal charges that could strike at its very core. Imagine US Marshals seizing bank accounts, a judge freezing Tether's assets. It would be a catastrophic event. The company is fighting back with all it has, lobbying, public statements, trying to rebrand itself as a responsible actor. They shout increased transparency, boast of cooperation with law enforcement on certain busts, and even claim they're setting a higher standard for the industry. But behind the scenes, survival is at stake. The question now, can Tether withstand the onslaught of scrutiny that's upon it? Or will the avalanche of legal and regulatory actions finally trigger the collapse so many have feared? To answer that, we must examine a rather peculiar irony of Tether's situation, one that gives it an unexpected form of leverage and influence in the traditional finance world. In a twist rich of irony, the crypto world's golden stablecoin has become one of the biggest holders of US government debt on the planet. Yes, that US government, whose regulators are bearing down on Tether, is effectively in business with it. How? Through US Treasury bills. As Tether's growth exploded, it had to park tens of billions of dollars of reserves somewhere. After trust in its commercial paper holdings evaporated amid the public scrutiny, Tether shifted heavily into what is traditionally seen as the safest asset in the world, short-term US Treasuries. By 2023 and 2024, Tether reported holding on the order of 70, 80, then $90+ billion in treasuries, an outstanding figure. To put that in perspective, if Tether were a country, it would rank amongst the top 20 foreign holders of US debt. One report noted Tether was the 19th largest holder, sitting between the nations of South Korea and Germany in holdings. Another attestation in late 2024 bragged it had climbed to 18th, surpassing mighty economies like the UAE and Australia. This is a hidden power play. By holding so much of America's debt, Tether entwines itself with the traditional finance system it once avoided. Those billions in T-bills earn interest, lots of interest, especially as US rates rose sharply. In 2023, when banks struggled with rising rates, Tether was raking in profits from its trove of treasuries, reportedly earning several billion dollars in profit in just one quarter, thanks to interest payments. In essence, the world's biggest stablecoin issuer became a significant lender to the US government, funding a slice of the national debt. Consider the implications. If Tether were to suddenly collapse or need to liquidate assets, it could theoretically flood the market with tens of billions in treasuries. Market analysts debate how much that would have. The US bond market is huge, but a fire sale of $80+ billion in T-bills in a short span could rattle short-term funding markets. It's a scenario likely not lost on US regulators. Some even whisper that this enormous hoard gives Tether a form of unspoken leverage, a reason for authorities to think twice about immediately crushing the company. Unless, of course, they destabilise the very debt market the government relies on. It's a kind of mutually assured disruption. Tether needs the US treasuries to shore up confidence in USDT, and the US wouldn't want a sudden liquidation of those treasuries in a disorderly collapse. At the same time, Tether's massive reserve shift was a direct response to doubts. Under the glare of skeptics, it cuts its mysterious commercial paper assets to zero, replacing them with transparent, presumably high-quality assets. Tether now says it publishes near-daily updates of its reserves, and even hired a global accounting firm to attest to its assets quarterly. It wants to project an image of strength, more reserves than liabilities, extra capital buffers, and ultra-liquid assets. One prominent Wall Street figure, Howard Lutnick, CEO of Cantor Fitzgerald, even publicly vouched for Tether's backing, saying they have the money. It's almost a surreal turn of events. After years of obstruction, Tether now claims to be more transparent than banks, showcasing US Treasury holdings as proof of legitimacy. But is this truly a sign that Tether has changed its spots? Or is it merely a strategic maneuver, a way to buy goodwill and time? Holding treasuries certainly makes Tether appear safer, but it also deepens its entanglement with the global financial order. It represents a kind of high-wire act, so to speak. Tether has inserted itself into a role where its failure could ripple far beyond crypto, potentially touching money market funds, other banks, and even international holders of US debt. In doing so, Tether might believe it has an insurance policy, a hidden network of stakeholders who now need it not to fail. Which brings us to the web of geopolitical and underground connections that Tether has fostered, a network that may be its strongest protection, and simultaneously, its greatest risk. Beyond the grand narratives of market manipulation and regulatory battles, the story of Tether is also one of geopolitics and global money flows, some legitimate, many illicit. Over the past half-decade, USDT has seeped into the underbelly of international finance. In China, where strict capital controls prohibit moving large sums of yuan out of the country, entrepreneurs and citizens discovered Tether as a convenient escape hatch. By 2018 and 2019, billions in Chinese wealth were quietly converting into USDT, then into dollars offshore, bypassing the Great Firewall of finance. A 2020 Chainalysis report noted that Tether was disproportionately popular in East Asia, particularly useful for capital flight from China. OTC brokers in China would trade cash for USDT, allowing locals to move value abroad in minutes, something that could take months or be outright illegal through the banks. Tether's own team acknowledged this dynamic in a rather roundabout way, bragging that their product provides an alternative to those hamstrung by capital controls. The same pattern repeated elsewhere in countries like Turkey, Venezuela, Argentina, places with unstable currencies or sanctions. People turn to Tether as a lifeline. In sanctioned economies like Russia and Iran, USDT became a shadow dollar system. Intelligence reports and congressional testimonies in the US have flagged how Russian entities pivoted to Tether to evade sanctions after the Ukraine invasion, using it to purchase everything from drones to luxury goods outside of the banking system. The US Treasury has raised alarms that crypto, with Tether front and center, is blunting the impact of sanctions on these regimes. Then there's the outright criminal underworld. In the murky realms of money laundering, drug trafficking and cybercrime, Tether has become a favoured currency. Unlike bank wires that require names and compliance checks, a transfer of USDT is near instant and pseudonymous. Law enforcement investigations, codename Operation Destabilize, amongst a few, have uncovered drug cartels and ransomware gangs funneling millions through Tether. In one Chinese case, a criminal gang laundered an astonishing $1.7 billion via USDT before being busted. The US Department of Justice indicted Chinese nationals for using Tether to buy chemicals for fentanyl, noting how invoices offered USDT as a payment option for these rather deadly deals. Human traffickers and scammers likewise moved their illicit proceeds with USDT until crackdowns caught up. Time and again, investigators found Tether at the heart of schemes to wash dirty money because of its stability and ease of transfer across borders. Ironically, these very illicit flows may have given Tether a layer of protection. How? Because to track and bust these criminals, law enforcement agencies have leaned on Tether itself. Despite its outlaw reputation, Tether the company often cooperates with authorities when prompted. In several high-profile busts, Tether throws hundreds of millions in USDT tied to criminal syndicates after discussions with the Department of Justice. Each time Tether does this, it sends a message: we're useful to you. In effect, Tether positions itself as a partner to law enforcement, a source of intel, a choke point that can be used to seize ill-gotten gains floating about in the crypto arena. Publicly, Tether advocates these actions as evidence of their compliance. One might see it as insurance, a way to remind regulators that, as unsavoury as it may be, Tether's continued operation gives authorities a handle on criminal crypto flows that would otherwise slip into truly untraceable channels. But Tether's integration into the shadow banking network goes even deeper. Leaked emails and investigations have shown how desperately Tether clung to the traditional banking system when gates were closing. In 2017 and 2018, as big banks shut down its accounts, Tether and its allies allegedly turned to a web of shell companies and middlemen to keep the money flowing. The Wall Street Journal obtained emails suggesting that Tether's intermediaries use falsified documents and fake sales invoices to open new bank accounts. One major Chinese trader working with Tether fabricated contracts for deposits and withdrawals to trick banks into thinking these were just normal business transactions, not crypto money flows. Even one of Tether's own co-owners was alarmed, writing that this partner was trying to circumvent the banking system with fake paperwork. Tether eventually cut that particular partner off for being too risky, but not before the pattern was set. The journal's report even alleged that some Tether-connected funds passed through firms linked to organised crime and terrorism, including entities that had hundreds of millions seized or ties to designated terror organisations. Of course, Tether denied knowingly dealing with such parties, dismissing the report as stale allegations. But the evidence of a frantic, by any means necessary effort to stay banked is quite hard to ignore. All of this paints a picture of Tether at the centre of a vast, shadowy network, facilitating capital flight for the wealthy and the desperate, enabling transactions for those locked out of legacy finance, and yes, criminals, but also helping to catch them. It straddles a grey zone between the regulated and unregulated worlds, and in that grey zone, it has accumulated allies of convenience. Powerful interests from offshore billionaires to cybercrime agents have reasons to want Tether alive, or at least to fear the void its sudden death would create. This is the hidden protection network, not an intentional cabal shielding Tether out of love, but a set of circumstances and stakeholders that theoretically shield it out of necessity. Nevertheless, history has shown that such arrangements can unravel spectacularly. Which brings us to a critical reflection. We've seen this kind of house of cards before, in fact several times, in different forms under different names, but with eerie parallels. From a storied investment bank to a so-called algorithmic stablecoin to a flashy crypto exchange, the past holds clues to Tether's possible fate. To truly grasp the magnitude of what might be coming, we must revisit those failures, the Lehman Brothers, Terra Luna, FTX, and ask ourselves, is Tether next? September 15, 2008, Lehman Brothers, a 158-year-old pillar of global finance, collapsed into bankruptcy. It was a slow-building crisis that suddenly snapped. Lehman had long been viewed as indestructible until its hidden debts and risky bets became impossible to ignore. When it fell, it nearly took the world economy with it. The lesson: even the mightiest institutions can initiate some rather fatal fragilities behind polished balance sheets. Fast forward to May 2022, Terra USD, a stablecoin proposed as algorithmically sound, lost its peg. Within days, an entire $40 billion ecosystem imploded, vaporizing the savings of thousands and triggering a wider crypto crash. It turned out Terra's stability was an illusion sustained by confidence and very clever marketing. Once doubt set in, the death spiral was, well, deathly. And then November 2022, FTX, one of the world's largest crypto exchanges, suddenly went under. Revelations of fraud, misuse of customer funds, and hollow reserves toppled the exchange almost overnight. Its charismatic CEO went from the king of crypto to accused criminal in a flash. Billions of customer assets vanished, and trust in the industry hit an all-time low. These three failures in traditional finance and crypto alike share a common thread: unchecked risk and deceit concealed beneath the illusion of stability. Lehman used creative accounting to mask its insolvency unit until it was too late. Terra convinced users that an under-collateralized algorithmic contraption was as safe as the dollar, until a crisis of confidence revealed it was anything but that. FTX built a reputation as a blue-chip exchange, yet behind the scenes, its books were a tangled mess of intercompany loans and tokens of thin air, one giant leverage loop destined to unwind. In each case, there were warning signs. People raised questions about Lehman's balance sheet gimmicks, about Terra's unsustainable yields and suspicious backing, about FTX's cozy dealings with its sister trading firm Alameda. But those warnings were drowned out by the narrative. Lehman is too established to fail. UST is magically self-stabilizing. And FTX is led by a genius who can do no wrong. Until reality came crashing in. Now consider Tether. Echoes of all three resonate here. Like Lehman, Tether operates in a high-stakes financial domain with vast sums of risk, and it has been accused of masking its true balance sheet health. Some experts worry that if Tether's assets were marked to market honestly, losses or illiquidity might lurk, masked over by assurances much like Lehman's rosy pronouncements before it failed. And just as Lehman's collapse triggered chain reactions, a Tether implosion could send shockwaves through every corner of crypto, and even parts of traditional markets holding its debt. From Terra Luna, Tether should heed the lesson of confidence as the ultimate collateral. Terra's UST maintained its peg until one day it didn't, when big players decided to test its defenses and found them lacking. Tether too relies on market belief that 1 USDT equals 1 USD. If that belief fails, even for a rumour or a brief liquidity crunch, USDT's price could slip away from $1. We've seen minor wobbles, a 97 cents USDT in 2018 during a bank scare, a 99 cents in 2022 when markets panicked after Terra's fall. So far, Tether has clawed back to the peg each time, but so had UST, several times, until the one time it couldn't any longer. If a critical mass of holders ever doubt Tether's backing and rush for the exits, the resulting run could be unstoppable, especially if reserves are not truly liquid enough to meet redemption demands instantly. And from FTX, Tether draws perhaps the most direct parallel: a close-knit corporate structure with conflicts of interest and a pattern of using one asset to prop up another. FTX and Alameda Research infamously blurred the lines, with FTX using customer funds and its self-issued FTT token to bail out Alameda, a house of cards. Tether and Bitfinex share personnel and owners, and indeed, in 2018, Bitfinex dipped into Tether's reserves to cover its own losses. In essence, Tether's backing was partly an IOU from its sister company, akin to FTX's FTT-backed balances. That entanglement was resolved publicly with the MYAG settlement, but who can say what pressures might recur in a crisis? The FTX saga proved even a highly trusted crypto institution can disintegrate in days if confidence evaporates. Tether, despite all assurances, could prove no different if its facade cracks under stress. The striking thing about these precedents is how quickly the unthinkable becomes the inevitable. 1 week, FTX was solvent, and Sam Bankman-Fried was the JP Morgan of crypto. The next, FTX was bankrupt and SBF in custody. History doesn't repeat, it rhymes, and all the rhymes are pointing to Tether. The size is larger, the stakes arguably higher, but the underlying theme is hauntingly similar. Complex fraud or mismanagement can persist for a long time, until one day, it doesn't. So is Tether next? It's a question spoken in hushed tones in crypto circles, often dismissed by those who can't imagine a world where Tether isn't thriving. But increasingly, it's spoken aloud by analysts, by officials, by anyone who has seen this movie before. The last act has yet to play out, but we can all sense the climax approaching. What might that look like? Let's cast forward in time to a hypothetical scenario that so many fear, yet one that is disturbingly plausible given all we've uncovered. Tick, tick, boom. Imagine for a moment that the storm finally hits. The news flashes across X and CNBC simultaneously. Tether loses peg, mass redemption halted. Perhaps it starts with a leak, a devastating report that Tether's reserves are false, or a criminal indictment freezing Tether's bank accounts. Maybe it's simply panic feeding on itself, but the result is the same. USDT, long steadfast at $1, starts trading at 98 cents, then 95 cents, and falling. Holders around the world race for the exits, each frantically trying to redeem their tokens for dollars on the Tether platform, or dump their USDT for anything else, USD, Bitcoin, Ethereum, before it all falls further. It's a stablecoin bank run, the likes of which we've never seen before. Tether's team scrambles to stem the bleeding. They issue statements, all funds are safe, redemptions are proceeding, but maybe withdrawals are indeed halted, either by choice or by circumstance. Perhaps banks have frozen Tether's accounts pending legal action, or simply the queue of redemption requests has overwhelmed available liquid reserves. As this realization dawns, everything implodes. Crypto exchanges, big and small, freeze USDT trading pairs. The prices are too volatile, the order book's too thin. On DeFi lending platforms, suddenly the collateral that was assumed to be $1 each is worth far less, triggering cascade liquidations of loans. Smart contracts start executing fire sales of other assets to cover the shortfall, driving prices down across the board. The crypto market plummets. Bitcoin, which had enjoyed Tether's artificial boost for years, now feels gravity in full force. A 30%, 40%, maybe 50% crash in a day, as billions of nominal crypto dollars evaporate from trading platforms. Every major cryptocurrency tumbles amid the frenzied dash for a true fiat currency. Even rival stablecoins like USDC and BUSD feel the strain. Some investors fear they could be next, so they redeem in mass too, or flee to cash. The entire concept of a crypto dollar takes a credibility hit. Stablecoins were supposed to be the safe parking spot. Now there is no safe haven in crypto. Outside of crypto, shockwaves make the grounds tremble. Companies that had exposure to Tether, crypto lenders, investment funds, Even some fintech firms reveal losses. A few smaller banks that banked with Tether or held its reserves face a sudden liquidity crunch. Regulators convene emergency meetings. The US Treasury and Federal Reserve issue statements to calm markets, emphasizing that mainstream finance is safe, that exposures to crypto are limited. Still, the psychological impact is profound. It's the Lehman moment for crypto, and confidence in the digital asset space is shattered. Global news outlets run stories of everyday people who lost fortunes, of the chaotic unraveling playing out in real time on social media. Lawmakers who were already skeptical of crypto now have the example they feared: a systemic risk manifesting from an unregulated corner of finance. The calls for draconian regulation or outright bans become deafening in many countries. And what about Tether's famed US treasuries? In this scramble, Tether would have to liquidate what it can to fulfill redemption requests, selling off tens of billions of treasuries and other assets. If done in a fire sale, it could nudge interest rates upwards temporarily, or find few buyers in a stressed market. The US government might even step in via intermediaries to quietly absorb those bonds to prevent disruption. Ironically, Tether's final act of breaking the buck would mirror a crisis from 2008, when a major money market fund broke its $1 peg due to Lehman exposure, prompting federal interventions. History rhymes once more. In the aftermath, the crypto industry would undergo a painful reckoning. Trust, already fragile post-FTX, would be decimated. Many projects and businesses that depended on Tether's liquidity could fold. Surviving stablecoins and exchanges would strive to distance themselves from Tether's model, emphasizing transparency and compliance. Perhaps decentralized stablecoin experiments would get another look, or maybe this will accelerate the entry of central bank digital currencies that offer the stability Tether promised without the counterparty risk. In fact, Trump's notable outcry for no CBDCs would be quickly counteracted in such a scenario. A classic case of the black swan, where the government swoop in with their own convenient solution to the crisis. Yet, amid such a wreckage, we cannot ignore one silver lining. The truth will have been laid bare. The collapse, as devastating as it would be, might finally expose every dark corner of Tether's operations, the true state of its reserves, the extent of any wrongdoing, the identities of those who benefited from the charade. It would be a cautionary tale written in very painful ink, ensuring that the lessons are learned and not repeated. Much like how the Lehman failure reshaped banking oversight, a Tether collapse would almost certainly reshape how we handle crypto assets going forward. But do we really have to learn the hard way? That is the urgent question we must confront right now, before this hypothetical becomes reality. All the warning signs are in front of us. We have amassed them through this investigation. We know Tether's history of deception is its critical structural weakness, its vast and uneasy influence. We've seen similar dominoes fall in similar fashion. The time to act is before the collapse, not after. If Tether is indeed a ticking time bomb, the fateful hours are only drawing closer. Will regulators defuse it in time with a controlled demolition, protecting investors and the markets? Will the crypto industry find a way to wind it down safely, transitioning to more transparent alternatives? Or will we continue in collective denial, whistling past the graveyard until the clock strikes and the explosion occurs? The calm before the storm is over. The clouds have gathered. Some drops are already falling. This is our final warning. Embrace it or face the consequences when Tether's storm hits, potentially wiping out much of what crypto has built. The choice and the time to make it is ours, but not for long. We've written 2 entire books on this topic within our app. It's available for free and paid members. Simply click the link in the description, head on over to our website, become a free or paid member, and you can read both of these books within the library section of our app.